goes, is to focus on alternative assets, because I think so many people get caught up in the headlines, the stock market and CDs and annuities and managed money, and all these things are paper. I mean, they're that's what they are, and none of them are hard assets and stuff. And I just think that when people start to, look at history and the United States and the world, it's probably very prudent to pay attention to some of the things that have happened. I mean, for example, when Nixon took us off the gold standard back in 1971, back then, by law, before he did that, there had to be $35 for every ounce of gold. That was kind of the backing and stuff. And now, we're printing money right and left. And I think that's one of the biggest issues going on in the world right now is that all of these central banks have been printing money basically to try and stimulate their economies. And if you're not paying attention, and that's fine, because, I mean, a lot of people, they're not like me, that every morning I wake up and that's the first thing I look at in the news, and that's okay. But, I mean, there's a couple of major countries, Germany and Japan, for example, that have negative interest rates. Now think about that for a second. I mean, our rates here in the U.S. are pretty doggone low. I mean, if you look at the 2-year Treasury and the 5-year Treasury and the 10-year and the 30-year Treasury, I mean, I think the 30-year Treasury, I can get on my phone here and give you the rate as of this moment, but I mean, I know it's less than 2%. And right now, what's really interesting is the 2-year Treasury is paying more interest than the 5-year Treasury. Now think about that for a second. If you were getting ready to make an investment in U.S. Treasury bonds, and you could get into the 2-year Treasury for a higher rate than the 5-year Treasury, why would you tie your money up in the 5-year Treasury? So getting back to France and Germany, they've been trying to stimulate their economy so much to the point where their interest rates are negative. So in other words, you're paying, if you're a German citizen or an investor that's buying a German bond or a Japanese bond, basically you're paying for the privilege of owning that bond. I mean, think about that for a second. You're paying, let's say, $950, and when the bond matures, it's going to be less than what you paid for it. And so, I mean, I don't know about you, but that's not exactly the way I like to invest. If I'm investing, I kind of like to do it the way currently the U.S. still is, which is, you put in $1,000 and you're going to get it back, 2% interest or 1.5%, depending on which one of those maturities you use, the 2, the 5, the 10, or the 30, and so forth. But anyway, rather than me ramble too much, Matt, I don't know, do you have any questions before I?
Well, so far, no. I got to get the camera back on me.
Oh, okay. Matt's working on the camera.
No, I mean, I when you were talking, I had the camera zoom in to just you. All they could see is my arm. But yeah, I've never really paid a lot of attention to the value of gold, silver, or in this case also cryptocurrency known as Bitcoin. And see, I always get paranoid about, if I were to invest all my money into Bitcoin, what happens if the internet infrastructure goes down? Mm-hmm. Is that Bitcoin still good?
Oh, yeah.
So yeah. That's the only worry that I had about that. But the good thing about it is that we're doing a show now. You're doing a show now that can explain some of these things, because a lot of people don't really pay attention to it. They think money is just money, but the more they print, the less value that dollar bill is.
Well, exactly. I mean, let's go back to my comment about Nixon in 1971. The U.S. dollar, as we know it, has lost something like 97% of its purchasing value since Nixon made that move. Now, think about it for example. I mean, we could talk about a loaf of bread, a gallon of gas, the price of a home, all these kinds of things. And, I mean, they've gone up astronomically. Whereas if you look at gold, which back in 1971, as we said, was much more modest, but not only has gold appreciated, I mean, this morning when I looked, gold was like $1,512 an ounce. But, I mean, that is by far and away much greater than it was in 1971 and able to buy as much, if not more, than it did in 1971. So, and we can, use all kinds of examples, going back even thousands of years. I mean, that's one of the neat things about gold and silver and these precious metals, is that they are a hard asset. And sometimes it's the simplest things that kind of rule their value, which is supply and demand. And without getting too far off into Economics 101, any time you've got a limited supply of something, be it a can of tuna at the store or, gold or whatever it may be, and you've got a huge demand, people queued up wanting to come in and buy that can of tuna or, to buy gold, it's going to drive the price up. And then the flip side works also. I mean, if all of a sudden there wasn't much demand for that item, that merchant or that government or that mining company, whoever it is we're talking about here, that's the supplier, they'll start bringing the price down, to meet that lack of demand. So that's, it's kind of one of those really easy equations in some cases. Now, what makes it more interesting is, the politics involved and the different countries involved and so forth and so on. And, I brought one of my little cheat sheets just to kind of keep me on course, because, one, I'm so excited to get back on the air. I could see
We've missed you.
Oh, well, I've missed you guys, and I could see me talking, and then all of a sudden it's, 9:59 and we got to go, and I haven't covered anything. By the way, before I go any further, let me just mention two quick things, and I don't know if you've got this streaming on the bottom of the screen or not, but one is if you want more information on metals and gold and silver, for example, you can go to a website called thegoldaffiliate.com. So
I'll be having that up here on the screen here shortly.
Okay. And then my number is 417-755-0700. Don't call till after the show because I got my cell phone sitting right here. And the ringer's off, so I'll be looking at you calling in there. But anyway, my point is if you want more information, the neat thing about the website I just gave you is the company that I have right now as my favorite. Not only will they give you free information and send it out to you and so forth, but they have a couple of DVDs.
And it's thegoldaffiliate.com.
Yes, sir. Yeah. But they've got a couple of DVDs. In fact, I should have had this out, but let me just see if I can find it real quick.
And
one DVD that I have with me is, and you can kind of see the cover here and so forth, kind of gives it away a little bit. It's Regal Assets, the Gold IRA company, and this particular DVD is called Hyperinflation is Inevitable When a Currency is No Longer Backed by Gold. And they've got two DVDs now going out with their packets.
And what's your number again?
417
Yep.
755 0700. And they also have, to commemorate their 10-year anniversary, for anybody who goes online and requests the information and stuff, they're sending out a silver coin. So it's well worth it if you've even got an interest, remotely as it may be in this and so forth, is to go to thegoldaffiliate.com. Look at what I've got on there and stuff, and if you're interested for more information, just fill in your contact info and they'll reach out to you and send the packet of information and so forth. But
I'm kind of crazy here, but how do you spell affiliate? Affiliate?
Well, let me see here.
I just want to make sure I get the spelling correctly. Otherwise, a lot of people will go to a site that's not where you want it to be.
Yeah.
I think I spelled it right.
It sounded right, but let me just make sure. Okay, so the Gold Affiliate is A-F as in Frank, F as in Frank, I-L-I-A, T as in Tom, E.com.
Okay, I had it right. Just wanted to make sure. I'll be posting.
I had faith in Matt. But I will tell you, that is one of the tricky ones, to maybe have one too many T's or something like that. But, getting back to some of my foundation of why I think this is important is that, in our world, in our country, for example, you've heard the stories lately how, the top 2% control, 98% of the wealth. Well, I mean, here's just some of the billionaires that are invested in gold. And some of these folks I didn't know. I mean, I don't want to, mislead anybody and have you think that, these people are in my, my phone book. But, I mean, here's Thomas Kaplan, over $2 billion invested in gold. John Paulson. Now, I've heard of John Paulson before. He's got over $4.6 billion invested in gold. Jim Rogers, I mean, if you watch CNBC or, any of the news stories focusing on financial, you've heard that name. He's got $300 million net worth, and he thinks, gold's a great investment for the next decade. In fact, this morning, I got to tell you, in Bloomberg, I woke up, and there's one of my favorite investors, a gentleman named Dr. Mark Mobius, and he's now retired, but for 40 years, Dr. Mobius was out traveling the world looking for emerging companies in emerging markets. Just a really neat story, a neat guy and stuff. And he's on Bloomberg this morning saying, gold's going to do nothing but go up, up, up. So go to Bloomberg and check out Dr. Mark Mobius for that one and stuff. Ike Batista, $30 billion net worth. Now, here's one you're going to love. I mean, I love just because I thought the guy's name was kind of fun.
Yeah, it is.
The richest man in the world right now, as we speak. I mean, as far as, measured by monetary things and stuff like that. Carlos Slim. And Mr. Slim is out of, I believe it's Mexico. He's got a $55 billion net worth. And, basically he's saying that gold is a big position in his portfolio. Carl Icahn, everybody's heard of Mr. Icahn. He's got a $12.5 billion net worth. Mark Stern, David Einhorn, George Soros. Now, there's an interesting name, George Soros. He has a $22 billion net worth, and he says the U.S. dollar is very weak. Investors are moving to real assets. And maybe in a later show, we'll talk a little bit more in depth about Mr. Soros and some of his strategies with the upcoming election and so forth. Paul Tudor Jones, Michael Avery, Eric Mendick, and Mikhail Prokhorov, just to mention a few. But that's like a dozen billionaires right there that are, very, very big on why gold should be in your portfolio. And let's talk about gold just for a second. One is gold is money. Now, I know this is going to sound like just a real, I'm being a stickler on definitions, semantics and stuff. But when it comes right down to it, the U.S. dollar is not money. It is currency. And ever since 71, it is fiat currency. And you'll hear that term tossed around as you watch these shows or I bring guest speakers on or, however we do this and stuff. Fiat currency, basically the definition is that it's not backed by anything. So, it doesn't have that gold standard behind it like it used to prior to 71. Anyway, gold has no counterparty risk. Now, I know that, sounds like, what does that mean? Well, think about it. If you're invested in, let's say, like Enron many years ago, and for years everybody thought Enron was the greatest stock in the world. No one knew that the management of Enron was grossly mismanaging the company. So that is counterparty risk, is having management that may not be ethical at the helm, and then therefore, even though you thought you had a decent investment, as it turns out, the results are not good. Gold is liquid and portable. You can exchange gold quickly and have your cash in your account, your Bitcoin in your account, whatever you want to convert it into, in a matter of hours, and in some case a matter of minutes. Gold requires no specialized knowledge. Gold hedges the stock market. One of the things you're always looking for, or at least I'm always looking for in some of these billionaire investors, is things that go in the opposite direction of the stock market. So, for example, when the stock market goes up, you want something that, is going to be like kind of stable. Maybe it'll go up a little bit. But more importantly, when the stock market goes down, you want something that's going to go up to counterbalance that particular activity. In fact, just to kind of jump ahead as far as my cheat sheet, let me just go ahead and keep that thought going, which is, if you remember 1987, Black Monday, and I'll never forget that day because I was out in Seattle, Washington, calling on advisors, and nobody after a while was taking my calls, and finally I turned the TV on and I was like, oh, that's why. It was off, the market was off 38.9% in one day. And so all the advisors that had, you know, a tie to the stock market, you know, after about, you know, their morning coffee were freaking out. At the same time, gold was up 5%. It was a 45-to-1 ratio as far as gold being up 5 while the market was down 38.9. The Iraq-Kuwait War back in 1990, gold was down 22.5. Or excuse me, the stock market was down 22.5. Gold was up 7.5. So a 31-to-1 ratio. In the dot-com crash of '01, and I don't know if anybody remembers that one. I definitely do, because it was, you know, as we were winding down 1999, just some of the returns were, you know, like astronomical, because everybody
People were freaking out.
Well, they were just, you know, it was like, oh, it's got .com in the name, I want it. And you can always kind of tell, at least I can, when things are getting out of control. You know, I had an advisor in Michigan that year that, you know, I went to call on him, and he was like telling me, like, earlier that day he had this little old lady come in, and her portfolio was up 48%, and she was unhappy. 48%. I mean, you know, that's pretty doggone good, but she was unhappy because one of the ladies in her bridge club was up 90%, and she wanted what her friend had. So she was moving her account from him to this other person down the street. And, of course, we all know what happened, which is the dot-com crash. The market was down 27%, and gold was up 1. So the ratio there was 29-to-1 in favor of gold. And then, last but not least, is this financial crisis in, well, I shouldn't say not last but not least. Let me segue into this year here just in a second. But the financial crisis of '08, the market was down 34%.
I remember that.
Yeah. I mean, there's
the trucking industry felt it pretty hard.
Oh, yeah. I mean, transportation, I mean, I mean, that was a brutal year.
Gas prices were up to nearly $4 a gallon.
So the market was off 34%, gold was up 5 for a 40-to-1 ratio. And, you know, I referred to this year. I mean, you know, I believe the S&P and the Dow are still positive for the year, and, you know, by most people's standards, still decent returns and stuff. But, I mean, if you haven't been watching, the volatility has been phenomenal. I mean, last week alone, there was one day where the market was down 800 points. Guess what? I started really asserting my influence, you might say, on folks back in May. And some of the early positions my clients were taking in gold were around $1,270 an ounce. And as I mentioned earlier this morning, gold was over $1,500 an ounce. Silver back in May was just over $14 an ounce, and it's right now touching $17 an ounce. So, I mean, just since May, we've had a phenomenal run in both gold and silver. But back to the reasons why gold is so important. It protects against crisis, which, you know, we'd already kind of alluded to with those 4 or 5 markets. It can protect against government intrusion. You know, a lot of people like to get gold bullion and basically have it. You know, have it in your safety deposit box, maybe better, have it in a safe somewhere in your house, someplace where if you need to, you can get to it. But it is definitely something that can protect against, you know, government intrusion, which, you know, I guess there's a part of me that's a prepper, and I don't want to get too far off in those weeds and stuff, but I will tell you, you know, we haven't seen it yet here in the U.S., but I mean, there's some countries like Argentina and Venezuela where, you know, at one point, just a few years ago, they were some of the richest countries in South America, and then each of them have had their own episodes where, like, almost overnight, their currency is worthless. And, you know, you start talking about going out in the street, and your currency's worthless, and you need to get food and water for your family. I mean, it brings on some not so fun things to go through.
That's a good way to put it.
Yeah.
It's frightening.
Since I was right there, next is gold's easy to store, low carrying cost. It can be private and confidential. You know, obviously you don't want to put it on your front doorstep and have a big sign with an arrow pointing, this is my gold. But, you know, and it's a tangible asset.
Really? Why not?
Especially not in Springfield these days. But, so, you know, there's just a lot of reasons why gold makes sense. And, you know, before I go any further, let me just stress, most people, in fact, let me flip ahead here and I'll give you some bigger names than mine. Because, you know, I'm one of these folks that thinks that it should be like 10 to 15% of your portfolio. But, you know, Ray Dalio is an American investor. He has the largest hedge fund called Bridgewater Associates. I mean, this guy is very, very, very wealthy and manages a lot of money. And he thinks 7.5% of your portfolio should be in gold. Tony Robbins. We've all heard of Tony Robbins. You've probably taken a Tony Robbins course if you're like me. You know, he's
a motivational speaker, correct?
Yeah, big tall guy with really the big teeth. Yeah.
He's got a massive head.
Yes, massive head. I think he's like 6'5" or 6'6" or something.
Yeah, he's pretty big.
But, you know, he thinks 7.5% of a person's portfolio should be in gold. Mr. Wonderful, Kevin O'Leary from Shark Tank. That's one of my favorite shows. But
I've only seen it a couple times when it first came out.
Kevin manages a lot of money for folks with the O'Leary funds and Softkey, and he thinks 5% of a person's portfolio should be in gold. Greg McBride from Bankrate thinks 5%. James Rickards. Now, this is a name you ought to be following if you're interested in this kind of stuff. Mr. Rickards is an American lawyer, and he has a lot of influence in the financial world, guest speaker at a lot of conferences and so forth. He thinks 10%. And then Frank Holmes, which is the chief executive and chief investment officer at the U.S. Global Investors, and he thinks 10%. So, you know, somewhere between 5 to 10% from these kinds of folks. I've seen folks, you know, do much greater percentages because of their own, you know, thoughts and feelings and so forth. I just think the key thing there is that each person should have a portion of their portfolio there. And here's one of the reasons why. You know, I mean, right now, I'll just do the headlines because I'm already looking at the clock, realizing we're going to run out of time, is right now the top 5 U.S. banks are now larger than they were before the '08 crisis. Remember this cannot fail concept that they had, you know, and too big to fail and all this kind of stuff? Well, these 5 banks are bigger than they were before '08. The FDIC admits it lacks reserves to cover another banking crisis. I had a client here back in June that I was introduced to, and this gentleman, you know, basically insisted on putting his $80,000 in a CD because he wanted that FDIC insurance. And what I told him was, and I'm serious about this, I said, okay, look, go put it in the weakest bank you can find. And he looked at me like, why would I put it in the weakest bank? And I said, well, if you're going to rely on the FDIC insurance, the weakest bank will be the first one to fail. The FDIC will be able to step in and help out. But if you go with the strongest banks, by the time we get to that point, if that happens, where one of those fails, the FDIC is saying, you know, admitted themselves, they just don't have the reserves like they used to. U.S. interest rates are already at abnormal lows, so the Fed has little room to cut rates. I mean, let's talk about that for a second. After '08, you know, when we had Mr. Bernanke at the helm of the Fed, and everybody was freaking out with, you know, the Lehman Brothers and the whole Wall Street issue with the derivatives and so forth, you know, what they decided to do was come out with this quantitative easing philosophy, which basically meant they were going out and just every month buying just a whole bunch of bonds, which was flooding the economy with cash and basically creating money. And so a little bit of that was the rates, the interest rates kept coming down, kept coming down, kept coming down. And, you know, if you look at where rates are today, you know, I mean, like I said, the 30-year Treasury is less than 2%. So if all of a sudden Mr. Powell, Jay Powell, who's the current head of the Fed, decided that he was going to do something. I mean, last month he did lower rates 25 basis points, and we kind of saw what that did. Obviously, President Trump is very involved in trying to influence him to bring him down even lower. But, I mean, how low can he go? You know, there's just not that much room between where we're at and zero. And I just don't think that you want to go to zero if you're the U.S. economy. One of the reasons we've been having kind of an interesting bond market of late, and a lot of people don't understand this, but if you're an international investor, an institutional guy, and you're managing billions of dollars, and right now you've got some money that's earmarked to go into bonds, what are you going to do? Are you going to take and buy zero interest bonds or negative interest bonds from economies like Germany or Japan? Or are you going to come to the U.S. and even though the interest rates may be a paltry 1.4, 1.5, 1.8%, are you going to, put those dollars to work with those kinds of bonds? And that's what's happening. Remember the supply and demand. We've got this huge demand happening right now, which is coming in and flooding the bond market, and you're seeing, the effects with these interest rates based on that supply and demand. So anyway, interest rates are pretty doggone low and probably can't go much lower. Markets are far more volatile now in the wake of Brexit and Trump's election. I'm old enough. I'm 61 years old. I can remember several presidencies where the president didn't seem to be involved with the economy. They didn't seem to be constantly bashing their Fed chair. I mean, I just think that there's certain things in the world that need to just operate on their own and not have influence from, other sources, if that makes sense.
Yeah.
And so, but anyway, a lot of people got psyched when Trump won, thinking that he was going to, change the tax laws and do all these wonderful things for businesses. And he has made some attempts, but then he's also, increased the trade war with China and the tariffs. And I mean, just last week he was talking about buying Greenland, and we saw how that kind of turned out. And anyway, like I said, we probably shouldn't go too far into politics. Next, American banks are not the safest place for your money. If you start looking at, like, Global Finance Magazine puts on a yearly list of the top 50 safest global banks, only 5 of those are U.S. based. And the top spot an American bank commands is only number 39.
Ooh.
Now think about that for a second. In a global economy that we thought we had before all these tariffs started changing things, and you've got the top 50 banks, the largest bank that the U.S. has on that list is number 39. I mean, something's wrong with this picture. I mean, not to get too dramatic and stuff like that, but, and then the last but not least, the Fed balance sheet is still expanded from the financial crisis of '08, like I said, with their quantitative easing strategy and so forth. I mean, they did things that probably most normal investors or CEOs wouldn't have done if they were, just trying to manage things prudently. But obviously, Bernanke and Janet Yellen after him and so forth, we're getting a lot of pressure to, let's stimulate the economy, let's try and keep this going and so forth. What's interesting now, just to kind of segue into these governments, since I brought a couple of them up here lately in this conversation, is banks and governments are stocking up on gold. I subscribe to a lot of different newsletters and foundations and so forth, and the results for the second quarter have just recently come in, and you would be astonished at the purchases of gold by companies like Russia, China, France. I mean, some of these countries are just buying tons and tons of gold. And, in the old days, they didn't do that. In the old days, they had a certain amount of gold, and they were happy with that. And, in fact, there's some people that think that there was a couple of years where the price of gold was being manipulated because some of these central banks would take and unload gold at certain times to keep the price down. Well, that's not happening now because they're starting to realize, hey, we want as much gold as we can have in case all these paper currencies are worthless. And it kind of alarms me that company or countries like Russia are buying so much. Now, right now, if you look at the top gold hoarders as far as countries go, the USA for the moment is, you know, right there at the top, followed by Germany, the International Monetary Fund, Italy, France, China, Russia, Switzerland, Japan, and the Netherlands. And those probably make up the top, you know, 10 positions and stuff like that. China and India are expected to ramp up their gold holdings anytime. That happened in the second quarter. The price of gold will skyrocket to new heights as this happens. So once again, supply and demand. And you know, if I'm going kind of fast, and I know I am. I mean, I know we're going to have other shows. At least I hope we do and stuff, because you know we're not always going to be talking about gold and silver. I mean, there's going to be a number of topics that I'm going to bring in that will kind of, you know, support some of these comments and thoughts and stuff. Bitcoin, we'll get into that a couple of episodes down and things like this. We'll have some guest speakers and stuff, but you know, there's just a lot of stuff going on that I think are things that everybody needs to know. And if you want more information that we're not going to have time to get to and stuff, you know, once again, you can go to thegoldaffiliate.com. You can take a look at, you know, what I've got on the website there. There's one button you can click to talk to an expert. There's one button you can click to request more information. And for a limited time now, as I said, honor the 10-year anniversary of Regal Assets. We've got a silver coin that we're including in the envelopes that go out. They're big, you know, usually UPS or FedEx envelopes chock full of reports like this one here. This is the Metal Investor Kit for 2019, and it's just one of about 6 or 7 reports that go out based on your interest and stuff. But somebody may be listening and thinking, Tony, you keep talking about gold. You know, I got gold ETFs in my 401k, or I got gold ETFs in my annuity, or I got gold ETFs because my broker or advisor says I've got gold ETFs or I've got access to them. And, you know, I'm not talking about those. I'm talking about gold and silver bullion, which basically are the, you know, the 1 ounce or the 100-ounce bars that basically are physical. You know, that's what I'm talking about.
Something you can bury.
Well,
or you can put in a safe somewhere.
And here's why. I mean, one is it gets more into the true value. I'm not talking about numismatics, you know, some of these coins and stuff. Now, I mean, granted, there are some coins that these governments issue that are top quality, you know, like the American Eagle coins, and for both gold and silver, and the Australian kangaroo nugget coins. I mean, these are all good quality type coins and stuff. But, you know, if you stray too far off the path, you know, you'll get into some of these websites and stuff that they're talking about these coins from, you know, all over the place. And sometimes you got to be cautious because they can have some incredible markups where, you know, you think you're buying X, and then, you know, you're getting Y because of all the markups. So I'm talking bullion. And the reason I bring that up now is that, you know, there's some characteristics between physical gold bars and coins versus gold stocks and bonds, gold ETFs, and gold futures. And one is there's a limited supply and cannot be created at will. Bullion's got that. The other 3 don't. And, you know, back, not to be redundant, back to that supply and demand thing. Can be used as a form of currency worldwide. Well, gold bars and coins can. You can't really walk into a store in Paris with a gold stock or a gold bond and exchange it for goods, or ETFs for that matter. There's no counterparty risk. Remember what we talked about a little while ago in the show. Gold doesn't have, you know, a CEO at the helm, or a COO, or a CFO. And I'm not saying that those kinds of titles aren't good. There's plenty of them that are very, very good throughout the country with different companies and organizations. I'm just saying that it opens up that amount of risk that, like an Enron, if you had somebody that, you know, kind of straight off the path and stuff like that, it lives outside the financial system. You can have your gold and you can have it outside the financial system, whereas you can't do that with gold stocks, ETFs, or futures.
Yeah, because gold stocks and ETFs are essentially paper representing gold, right?
Correct.
So it's basically the same as what's supposed to be, what our money is supposed to be. back when our paper money, it was backed by gold and silver. That's why I remember having, when in the early 80s, I collected coins and stuff, and I had a dollar bill, but it was a silver certificate.
Ooh, yeah.
Meaning it was a dollar that was backed by actual silver. So that, then I don't know if I still had one. That probably would be worth something today. But
those were cool. Remember they had kind of that little blue
yeah.
tint to them and stuff. Yeah.
Yeah, and it said silver certificate on it. And I was always wondering what the difference between that and a regular dollar bill is. Well, the silver certificate would stay the same as in regards to like what silver was worth, you know. I guess, and I mean, I'm assuming that's what it was for. And I don't know if they had gold certificates that were backed by the gold standard or not.
Well, they used to prior to 71.
Yeah.
You know, but you know, Nixon.
Now
made
they're
that
just
change.
printing money and putting it into circulation, causing the value of the dollar bill to go down.
Exactly.
So, I mean, money needs to be backed by something that is a hard asset.
Well, I mean, in a perfect world. I mean, that's just. I mean, there's just all kinds of examples. If we had time, we can get into. As I mentioned before, Argentina, Venezuela. You know,
which are not doing very well right now.
No,
Venezuela.
I mean, you know, we can look at Europe. I mean, just here lately. I mean, Greece has been having just terrible problems the last 5 or 6 years. There's talk that Italy's got some issues that are starting to unravel. I mean, you know, there's just some not good things happening around the world from a financial standpoint. Back to the last two things about physical gold. One is it can be stored anywhere in the world, and especially if you want to have it in a safe haven jurisdiction. You know, a lot of people look at places like Singapore, Dubai, Switzerland, you know, just to name a few off the top of my head. But, I mean, there are some places that are considered safe havens around the world to store precious metals. And then liquidity. And gold bars are very liquid as compared to gold stocks and bonds would have medium liquidity. And gold ETFs are very liquid, and gold futures have medium liquidity. But, you know,
they call that liquid assets?
Yeah. In other words, how quick can you turn it into cash?
Right, like your house. If you own your house, that's a liquid asset, correct?
Well, it's a liquid asset, but it would take a little while to find a buyer.
But gold is immediately worth what gold is worth.
Yeah, if we had a gold bar sitting right here, we could turn it into, you know, cash in an hour.
Yeah.
You know, I mean, it's that simple, if need be, and so forth. The purchasing power. Now, this is where this gets really interesting, okay? And some of you in the audience, you know, you're going to be old enough to relate to this. Maybe not this first date. I mean, there's a few folks out there that were born in 1913. But in 1913, if you had a 1 ounce gold coin and a $20 U.S. bill, they would buy the same amount of stuff. Now, for this example, I'm going to use cups of coffee. And so, you know, you've got, in 1913, it looks like a $20 U.S. bill would have bought something like, gosh, I can't even factor how many they've got in here, but, you know, they're just about a lot of cups of coffee, and they're equal on each side. You get to 1950, and actually in 1950, it looks like the $20 bill would have bought maybe one more cup of coffee than the 1 ounce gold coin. But then you get to 1980, and 1980 is gold. Gosh, I came and look at this. Let me see. 1, 2, 3, 4. About 40 cups of coffee versus just, you know, like one for the $20 bill, which I'm thinking back to 1980. I don't know where they were going. It must have been a lot more expensive than Starbucks. But in 2019, this year, let's talk Starbucks. If you had a $20 bill, and a lot of you guys guys and girls can relate to this, because I see everybody lined up at Starbucks every morning on Glenstone or Campbell or wherever they're at and so forth, Battlefield now and everything. But, you know, I mean, think about it. If you had a $20 bill and you went to Starbucks to buy coffee and you weren't getting one of their crazy fancy ones, you'd probably end up with about 4 cups of coffee. Whereas if you had a 1 ounce gold coin, now think about that. 1 ounce of gold right now is just a little bit over $1,500. So you take the price of a cup of coffee and divide it into 1,500, and you're going to be having plenty of a bunch of coffee for your friends. But, I mean, that's kind of what we're talking about, taking all joking aside and stuff, is the purchasing power of your dollar has gone down so much since just 1971. In this example, we had 1913, 1950, 1980, and 2019. But there again, I mean, rather than me read it, if you'd like to have this report and the other reports that we've put together, by all means, please go to the I don't even think it's www. It's just thegoldaffiliate.com.
I mean, yeah, the computer automatically put the www.
Okay. Okay. So, risk profile per asset type. If you're familiar with the investment pyramid, gold would be right there at the base. Gold would be kind of the foundation of what you are. And I keep saying gold, really what I should be saying is gold and silver. Because, I mean, really, they've kind of fallen into the same category as far as precious metals. Yeah. I mean, there's a lot of people right now that really think that silver is more attractive than gold, and here's why. First off, there's normally a gold to silver ratio of, I want to say, probably an ideal world, something like, 30 to 1. 50 to 1, a lot in our most recent history and stuff. The other day, I did the math, which all I'm taking is the price of silver and dividing it for 1 ounce of silver and dividing it into 1 ounce of gold. And the other day, this is going back a couple weeks ago, it was 93. 93. Now, I got to tell you, there's only one other time in the last 2,000 years that I can think of where it's been over 90. So there's a lot of folks that are saying, okay, there's two ways that can adjust. One is the price of gold can come down, or the other way is the price of silver can go up. And there's just a whole list of reasons why folks are thinking silver is the place to be. Because, I mean, there's a lot of industrial uses for silver to go along with, just the value and stuff. The other thing is if we ever did have a, just a terrible thing happen, where currency was no longer viable, I mean, it'd be a lot easier to walk around town with an ounce of silver or a couple ounces of silver in your pocket and, buy your gas and your groceries and all this kind of stuff as compared to an ounce of gold. I mean, if you walked into a store with an ounce of gold today and it's $1,505, how are they going to create the change and stuff? So, I mean, there's a little common sense rationale with why silver might make some sense and stuff.
Literally.
Yeah. What you'll find is that for the last 10 years, we've been using gold and silver, palladium, platinum, these precious metals, and I'll get into some of these in future shows and stuff, but we've been using them in IRAs, because what's more important than your retirement account? I mean, enough people have had situations where they thought, oh, we've got X saved up for retirement, and then I know I beat Enron to death here, but all of a sudden their Enron stock's worth nothing, and that's what we're trying to encourage people to think about is why not have some precious metals, some gold and silver, in your IRA? And our company that I've been talking about this morning, Regal Assets, that I'm an affiliate with, is very, very good at the precious metal IRAs. They've got diversification. The storage, if you want to have us storage, it's done by Brinks. It's guaranteed by Brinks. I mean, there's just all kinds of benefits to thinking about having some precious metals in your IRA and so forth. If you've got a 401k or an old 401k at a company you worked for 3 years ago and it's still sitting there like a lot of people I encounter do, you might think about, once again, giving us a call, 417-755-0700, or the goldaffiliate.com and so forth. And, I mean, I can kind of go into a little bit more of this, but what I thought I would do is rather than do that, since our time is kind of quickly going away here, is turn it over to Matt just for some more questions. I mean, I know, this is one of the reasons, Matt, when I walked in this morning, he was like, hey, you want me to sit in? And I'm like, you know what? I get tired of hearing myself talk, so I can only imagine what our viewers on YouTube and Facebook and listeners on the radio are thinking and so forth. So I just always got a kick out of Matt and some of his questions and things that he interjects and so forth. So I don't know, have I gone too fast or too slow?
No. I do want to let everybody know that this show is brought to you by naturalsolutionstore.bz. There's a lot of products on there for your day-to-day health to help you cleanse your liver, help with your back pain, neck pain, to help with heart health, and brain health. Brain health is really important because a lot of people lose their brain. As you get older, your brain seems to, get older with you. So go online, check it out, naturalsolutionstore.bz. As you can see that we've actually had, on my end, on Facebook, we've had the camera zoomed in on you more today than myself.
I'm sorry.
So they can see my hand moving around, but that's it. Plus, I have these little things that pop up from time to time that I put up there. It says, Matt says, whoa, that's a lot of Joe, kind of stuff. But platinum is another, it's a precious metal, right?
Oh, yeah. In fact,
isn't it worth more than gold?
Per ounce, I think right now it's a little less. We have on our website, we've got gold, silver, palladium, and platinum. And there's other metals out there that people look at, rhodium.
See, I never even heard of that one.
Yeah, rhodium's kind of an interesting one and stuff. We don't have it available as we speak in an IRA, but as far as my comments about future shows, I plan on doing this, which is, today was just kind of like,
introduction.
Let's get a little foundation set as far as why we did this. I think the bottom line for me is that since I was, constantly talking to Jim about this, and he was seeing some positive results, why not share this with, the whole ministry? And we're not, saying, hey, run out and do something today, but we are saying that some of this is information that is
30 seconds.
Yeah, information that's good to know and stuff, and allow you to be a good steward of your assets and resources and stuff. So I know our time is fast escaping.
Yeah, we got like 5 seconds, really, to where we should.
Thank you.
Well, thank you, everybody, for joining us on the Gold Standard with Tony Hammock today. He'll be back on next Wednesday. Back next Wednesday. Same time, same channel. So, well, God bless you and keep you, everybody. We'll talk to you. Tony, thanks for being on today.
Yeah, thanks for having me. Thanks, everybody.